Hi, it's Paddy Hirsch at Marketplace. So if you think you're going to run into trouble, it's usually a good idea to tell somebody about it. In corporate America, this is called issuing guidance. It's a bit like our friend Emily here. She thinks she's going to be going out for a big night with the girls. What does she do? Well, she warns her mother. And the reason she does this is because if she rocks up rolling drunk at 2 o'clock in the morning, it means her mother might be a little disappointed, but she's not going to be particularly surprised. Also, if she shows up at 10 o'clock in the evening without having drunk a thing, her mother's going to be delighted, right? So companies do the same thing when they issue guidance about their finances. And it's really all about this lot, the investors, because they don't want the investors to be freaked out by the quarterly earnings report. So if the company's had a dodgy quarter, it'll issue what's called a warning. All right, it'll say, oh, maybe we've been having some profits problems and we want to make sure that you guys know about it, that our earnings report isn't going to be as good as we thought it might be. Now, this is great news for the investors because it allows investors like us, like you, like me, to decide whether or not to buy, sell, or hold a stock even before the earnings report comes out. The problem, of course, is that the company might be managing our expectations a little bit too much. It might say, issue bad guidance and follow it up with a perfectly good earnings report. And if you and I have sold our stock on the guidance, when the news of the good earnings comes out, the stock's going to go through the roof, but we haven't got any because we've sold it, and that's going to leave us, rather badly, needing a drink. Ooh.